but I do want to spend just a second to say thanks again to Stocks and Commodities. Such a great magazine, such great strategic partners for the summit. They've been doing a great job in supporting our summit since the very first one. I think we're on 6 now or something. These keep getting better and better. I really appreciate everybody coming today. I really appreciate Stocks and Commodities. It's a great magazine. You should be subscribed to it. And a good way to get 2 years for free is to go to metastock.com/summit and sign up for any of the add-ons. That'll actually include 2-year subscription as part of the package. So the next presenter is another friend of mine, Roy Swanson. I think I heard Roy coming on. Roy is somebody that we've been working with for a couple of years now. He's got a very interesting take on the RMO. I've actually been through all of his lessons, all of his classes. They're very, very good. It's a kind of a unique total turnkey solution where it basically gives you every single rule set. And Roy, let's go ahead and have you unmute your microphone and we'll get you on here.
Hey Jeff, how are you doing?
I'm doing great. I know you only have about 30 minutes, so I'm going to get out of the way. I'm going to let you go through it. Let's go ahead and get the screen share over to you. Yes. Okay. Now you should be able to share your stuff.
Okay. Can you see it?
I can see it.
Okay. Thanks a lot, Jeff. Yeah, let's get going because I don't want to talk too fast. We're going to talk about triangulating your trades. It's a 3-indicator strategy that I've developed for MetaStock, and I'll just have to agree with Jeff. 25 years in a row, yes, I use MetaStock because it's the best. It's got all the tools, it's just got everything in there. We've developed a strategy that uses 3 of them, including RMO, and we're going to get to it during this presentation. So we have the typical disclaimer. I'll just abbreviate it. We're not brokers or certified financial planners. All the results are illustrations based on simulated historical trades, and past performance on this trading system is not indicative of future performance. This is solely our opinion, intended to stimulate your own explorations in trading. So a little bit about me. I'm the founder of SteadyTrader.com. I've been trading for about 20 years, since the beginning of the online trading era in the 90s, when it was so easy to make money trading. Not as much today. I was actually requested to work on the first derivatives for DLJ. They found out that I was a math geek. I didn't know what derivatives were back then. I didn't know they were going to be hot, so I actually made a mistake and turned them down. But I did go on to be a consultant to about 6 trading system providers over the next decade or so. Got about 25 years experience with my partner, and because we've worked on so many other systems, we know the strengths and weaknesses of trading systems. About a year and a half ago, we decided to create SteadyTrader.com with our own favorite trading system. And so we're going to talk about that today. On the agenda, we're going to talk really about scanning for accurate buying signals. And we have a 3-point methodology. You could look at it as kind of a story about I got lucky with MetaStock and found a system that works, but I think you'll also see there's a little method to the madness here. It begins with setting the right goals. It continues with using the right corroborating indicators, and then finally making the right decisions. So we're going to talk about this 3-step process here of developing this trading system. At the end, we'll talk about how you can get a free copy of our book, Read This First Before You Buy Stocks. I think a lot of us now understand that the stock market has fundamentally changed in the last 2-3 years. This book was written about 2 years ago in the midst of that change, and it outlines what I call the new rules for the new stock market. And if you agree that there's been a fundamental change, I think you'll find this book a very interesting read, because we talk about a lot of the fundamental architecture of the way stocks are traded and how it's affected everyone. So we're talking about systematic trading today, and I just want to get this on the table real quickly. We have a bias. We have a bias against trophy trading, which is what's promoted in the media, versus systematic trading. Trophy trading is about big wins, right? But big wins are needles in a haystack. They're very high risk because there are not many of them. They often rely on news as opposed to tools that you can use. And they're a low percentage play, just like any kind of big win is a low percentage play. It's like hunting. Systematic trading is like farming, right? I mean, it's consistent. The winners are always available. It's not looking for needle in a haystack. You're looking for winners every day. That makes it much more of a low-risk approach. You use tools and discipline as opposed to, listening for the news on this or that stock and breaking news and fundamentals or whatever. Not that these don't have an effect, but systematic trading is really more about using tools than the news. And that makes it a higher percentage play because, again, there are lots of available winners every day, and it's like farming. And I think we all know the history of the world is that if civilizations didn't depend on farming, we'd all be dead because hunting is just not dependable enough. So we're going to talk about developing a system here. And the first thing we did, which I think is a little bit unusual, and I hope you can take away something from this, is we realized you have to set the right goals. And so we decided, well, what are the goals? What kind of trades are we looking for? The first goal is activity. How often do you want to trade? How much time do you want to spend trading? I mean, these are fundamental questions that people don't always ask themselves. The second was time horizon. How long do we want to hold our time, our positions? What kind of hold times are we looking for? And the third is gain targets, percent per trade. What kind of gain target is acceptable? In other words, we're spending time and money trading. What kind of gain targets are going to be acceptable for us? What kind of ROI is acceptable? And so we set about actually developing our goals before we actually develop the system. So when we talk about activity, and you'll see there's a problem with goals, and the first problem is that the market has changed. And we realized we really have to be trading the market as it is and not as we wish it were. This is the market. This is the market the last 2 years, okay? Some people call it the go nowhere market, but actually it's going places. It's going up and down. It's been going up and down, at the extreme, somewhere around 10% up and down during these corrections we've had in August and January. But this is the market as it is, and it's been frustrating a lot of traders over the last couple of years. This is the market most people are trading, and that's the source of the frustration. People are so used to the always up market. Put your money in the market; it'll always be a good place. It'll never let you down. Well, that was then. This is now, and it's been 2 years. I think it's high time we all as traders understand that this is the new market, and the new market is characterized by short, strong cycles. And it's really because the big block buyers, the institutional buyers, they take their profits very quickly. When they see a profit, they take it, and then they get back in. They're all on the same page, the institutional players now. Everybody's on a short, strong cycle paradigm, and I call it the victory of market efficiency. In other words, when the big block buyers, they get in there on a daily basis, they take their gains. So the market just keeps going up and down, seesawing up and down, because that is what the bulk buyers are creating in what really comes down to the ultimate in market efficiency, driven by computers, driven by good information, and all the other things that make for an efficient market. So, getting back to this picture, this should be no surprise, because as soon as there's a bit of a gain, whatever, the big block buyers are selling. And when there's a bit of a trough, they come back in and buy again. So it's up, down, up, down, up, down all the time. So let's talk about activity. We take our lesson for activity from the worst period in trading that any of us can remember, and that is the big crash in October 08 to March 2009. And here's the lesson. It's very simple. If you were kind of a monthly trader, if you were holding positions of 3, 4, 5 weeks, 6 weeks, clearly the crash hurt. It hurt like crazy, and many people found their portfolios cut in half or worse. But when you look at the same period of time, and this was the worst down market we've ever experienced, you see that the same period on a daily basis was really not so bad. 41 out of 105 days were up days. In other words, just buying the SPY, you're up. on a daily basis. That's really not, 40% isn't that far off of 50%. The point being that if you engage on a daily basis, that seems to be the correct, at least in our opinion, the correct amount of engagement. Letting things slide for days and weeks at a time just isn't moving quickly enough to take advantage of the way the modern market works. And even in the worst situation imaginable, there were plenty of days, there were, again, 41 days out of 100 to make money. And what we say is, what crash? I mean, in fact, on a daily basis, there wasn't much of a crash. So the next goal we were thinking of, again, was the time horizon. And I think the rule here, a lot of people acknowledge this, is that shorter is better. The average hold in 1960 was 8 years. And I think we've just sort of shown why that's just not realistic anymore. In 2014, it was down to 5 days from 8 years. And of course, now, as we just talked about, professionals are trading, the big blocks are trading minutes to seconds, the high-frequency guys. The market is just moving very, very fast. And one of the reasons that so much of the volume has shifted to short-term holds is that you avoid corrections. In other words, we think the real way to look at a short-term position of a day or two is that if you're doing that on a regular basis, it's not so much about the position, it's the fact that you're always getting out of your positions. You're always pulling your money out of the market. And if you're always pulling your money out every couple of days, then you tend to avoid these corrections that are hitting with some regularity at this point. So that's sort of the other way of looking at why shorter is better. It's safer, in our opinion, if you could use such a word when it comes to trading. But really, if you're in the mindset of always pulling your money out constantly, less of a chance you get caught in the big correction. So we tend to champion what we call a quick cycle portfolio, which is cycling chunks of your money. If you had a $25,000 portfolio, putting $5,000 in every day, pulling it out every couple of days, and making a few percent a day, letting that stack up to considerable monthly gains at the end of a month. Now, the third goal we want to basically settle on ahead of time was gain targets. And as you can see, I think from what I've said so far, we believe in modest and realistic gains. We're into systematic trading. We're looking for gains that you can find any day, any market, and there are always gains out there of 1 to 5%. They're always available, so let's just go and find them. That was our sort of mindset going into this. You can make 1 to 5% in a day or two. You don't need to have a long hold, so the gains are in agreement. If they're in concert with our position on how long we want to hold, what our time horizon is, the gain target is in agreement with our activity level, which is basically being engaged every day. Because these types of small gains, they're always there. They're always available. So when we decided to actually create the system, we wanted to draw from some of the fundamentals of decision theory, and I call this the power of three, or triangulation. Triangulation, a lot of you probably have heard that it was used by navigators, the old seamen, Columbus, all those guys, basically to find out where they were located. But triangulation is also used to make decisions since antiquity. When you think of the concept of a tribunal, 3 judges. And the reason 3 works is that if you have 2, you don't get a decision. You have one taking one side, one taking the other. And if you have 4 or 5 or 6, you have too many conditions and you very rarely get agreement. But with 3, it sort of forces an agreement. You're either going to have, 2 yay, 1 nay, or 3 yay, or 3 against. But the decision will be clear and it will be corroborated by multiple inputs. So thinking about the power of 3 in terms of using that in decision theory, we decided to look for 3 indicators in MetaStock that we could put together to create a powerful strategy that would hit our goals. Goals that are based on the modern market. We wanted to find short-term moves that match the current conditions. Now, when we started looking at technicals, we came up against what we see as one sort of cautionary flag, and that is that a lot of technicals trade what we call the old market, and that's because they were developed, some like candlesticks hundreds of years ago, some like the Elliott wave, almost 100 years ago. But all of them, even the more recent ones, were developed before what we call the new market, before the computerized market, before high-frequency trading, dark pools. It was a slower-moving market. So we decided to start with RMO, largely because it has a good reputation, but also because RMO was developed in 2005. It's really one of the few what we call modern market indicators. So we decided to say, okay, let's look at RMO as our first indicator. And RMO is incredibly accurate. I'm sure a lot of you have used it. The only issue we had with RMO is that you're looking at these buy signals here on a sample chart, and RMO tends to spec out what we call long-term gains over a longer hold than we were looking for. Remember, we were trying to create a strategy to meet our goals, which was short holds of just a few days on a daily basis, and RMO just seemed to be more in terms of trading over the span of 5 days, a couple of weeks to a couple of months positions. So we developed a strategy to tighten up RMO, starting with RMO, to use it in conjunction with two other indicators. The first indicator are the Wilder's equations, the ADX, the PDI, the MDI, because these can be set to tighten up the scope of RMO. And we get trades that look like this when we overlay Wilder's equations with a tighter time horizon onto the native RMO scans. And this is exactly the kind of trade we were looking at. You can see a signal, target entry the next day, and then getting out in a day or two. Basically, these trends are 1, 2, 3, 4, 5 days maximum. You can see no trend here, no trend here, but bingo, with the overlay of RMO and the Wilder's work, we were able to get nice, significant pops that last just a couple of days. Here's another one, FXP. This was a 3x leveraged inverse fund in China during the correction in August. This was a terrific trade, but again, not much of a trend going in. Certainly not too much of a trend after the few days. But the combination of RMO and Wilder after the signal tends to really be pretty accurate. We're getting well over 80% of a short-term move of 3, 4, 5 days that's worth trading. Here's another one from September, AGS, and again, it's almost always the same type of trade. But remember, this was the goal. The goal was to find trades like this, trades that move up quickly within a couple of days. And it's all about these two indicators giving us the power to find these trends. Here's a recent one, EBIX from just a couple of days ago. Actually, the fifth day was Friday. The signal here on the 18th of April, and 5 days later on Friday, it was almost 8% gain in just, again, 5 days. So the final triangulation, we have RMO, we have the Wilder's short-term trending. We decided to use order book buying pressure because order book, and that's the on-balance volume indicator in case you're looking for it in MetaStock. And what we do is we overlay this onto the trades we're getting with RMO and Wilder as a final corroboration. And as you can see, if the on-balance indicator is moving upwards, if there's a nice slope to it, a steep slope, that generally indicates a strong trend. It's a final corroboration. You can see that the trend started, the OBV started moving up here, signal kept moving, and it's interesting that right when the time to get out, the OBV starts going negative, so this can also be used as kind of an exit indicator too. If you're sitting here on the fifth day wondering if you should get out and you see, well, gee, the OBV has turned negative. So as a final corroborator, we have layered on the OBV, and just to show you how it works, here's a couple more examples from the end of October, CSH. You've got the RMO buying signal that's already been filtered through the Wilder. And when we see the signal, we saw a nice steep curve here on that night, and then of course it kept going up. Nice 12% trend in 3 days. Finally, EBIX, which we just showed you. This is what the OBV looked, again, layered on top of what we did with the RMO and the Wilder's work. Here you can see that the curve, again, is very, very steep. So what we look for is a very steep curve, slope, to corroborate the buying signals. Now, getting back to why these three indicators work together, and again, I want to just delve back into a little bit of decision theory. We all know when you have a big decision, you want to break it up into multiple small decisions because of the law of compensating errors, which states that, you know, if you make a lot of little decisions, odds are you'll get most of them right, and the small decisions that you make wrong won't really impact on the result. That's why corroborating indicators, using several indicators together, tends to produce more accurate results. You'll notice we're using a triage process. We're prioritizing, we're going RMO to Wilder to the OBV. It's sequential, selective filtering. Again, this concept of triage, of narrowing down the scope has been taught in mathematics, you know, Venn diagrams, smaller and smaller subsets getting to the more accurate sample size. This is what we're doing with a system like this. And here you see how each of the indicators really supports and adds something to the equation. And this is why we did all that groundwork in the beginning, defining our goals, defining our activity levels, because just throwing 3, 4, 5 indicators into a pot doesn't mean you're going to come up with a great tasting soup at the end of the day. These three indicators each do something different. RMO is kind of medium term, Wilder trends are short term, and the OBV, order book pressure, that's really immediate. So we're basically ratcheting down the time factor here on what does it look good, medium term, short term, and immediate. And they add up and support each other. The RMO buy signals are kind of just it's up or down, yes or no. The Wilder's equations tend to give you a reading on the strength and the life cycle of the trend you're looking at. And the order book also gives you ratings on the strength based on the degree of the slope and the direction of the trend. Finally, the one is a complex formula with a lot of obtuse math in it. Wilder is slightly simpler, and the OBV at the end is more or less a direct measurement of the buying pressure of the price action of the day. So again, each one of these indicators adds something to the mix. They have different strengths and weaknesses, but they add together to form what we find is a very, very tight triangulation or corroboration for a signal. People ask us how about in a correction in January. We had our best month since August. We basically scanned for leveraged inverse ETFs. These are a few of the trades we had when the market really took a dive in January, and we tend to get much, much better than average results when the market goes down, actually. Proving the old saying that all movement is good movement if you have the right system and the right signals. This is the track record of the portfolio trading all of the green light signals since January of 2015. And we do something a little bit different than most strategy providers. We discount the results by 40% because nobody trades optimally. Nobody gets the best entry and exit. You know, everyone fudges things a little bit their own way. So we discount the results by 40%, and we still averaged 5.5% a month all through the last 15 months or so. Never a down month. Again, very, very consistent. That's what we were looking for. But this gives you some idea of what happens when you're out there every day, trading actively, just looking for stocks that are going up 2, 3, 4, 5% in 1, 2, or 3 days, putting your money in, pulling it off. Basically, I say taking your pennies off the table while they're real and letting them add up throughout the course of a year. So I wanted to go through this pretty quickly. If you have questions, you can go to steadytrader.com. That's our website. I want to make it simple for you. Everything is there on the home page. You can request actual signals or trades list. Shoot me an email after the presentation. We can send you a copy of the presentation. And you can get a copy of our book, Read This First Before You Buy Stock, by simply going to the homepage, steadytrader.com. There it is. There's the URL. There's our email address and our phone number, just to make it easy. I'll pop over to the questions now and see if there are any questions now. I want to leave plenty of time for that. So let's start here. These are buying signals. As we showed in one of the slides, we can use the OBV indicator to give guidance on when to exit when the OBV turns down. Does not work with a tablet when running Windows 10. I'm not sure about that. I use a PC. Are we trading stocks or options? We just trade stocks. I think you might be able to use this for options plays, weekly options, but we don't have any research on that. This is a simple strategy for trading stocks. All buys are long because we use inverse ETFs when the market is down. We use MetaStock's daily, end of day, standard subscription, base subscription. Where's the Wilders on the chart? The Wilders wasn't in the chart. We use that in the scan. We feed the RMO into the Wilders work, so they basically support each other. But in MetaStock, it doesn't actually give buy signals for the Wilders. So what happens is that the Wilders work actually limits the number of RMO signals we get in our reports. We use those two together and then overlay the OBV. Is your third indicator the on-balance volume? Yes, it is. We have down weeks, though. No, we actually have not. I mean, the accuracy rate has been basically over 80%. We haven't really had any down weeks or months. The monthly returns are buying. These are buying straight stocks and ETFs. We don't do options ourselves, although we know that some people are using this for weekly options. How much time? Running these scans really only takes about 5 minutes. Jeff and the team at MetaStock have created an auto installer. You pop it into MetaStock and it runs the scans. What we spend a lot of time doing, which I didn't talk about here, is we take about 10 signals every night and then evaluating which are the ones we want to take. Human judgment at the end of the day, and how to evaluate what signals are better than others. I mean, even with a system like this with highly accurate signals, there is a step to take, or basically to cherry pick the best signals each day. So we spend about 5 minutes on the scans and probably about another 10 minutes picking the best 3 or 4 out of the 6 to 10 that we get. Can we find a cheaper indicator than RMO? We use the standard RMO that comes with MetaStock, so it doesn't cost any extra. We're not talking about the add-on at all. How many stocks can you be in at a time? Well, that portfolio that we showed was a $25,000 portfolio, so the system, when it's really active, will generate 4 signals a day with about 2 to 3 of them executing. So it can be as many as 10 trades a week, but the average hold is really about 2 days right now. So you're in and out, taking your 2, 3, 4, 5% off the table as soon as it hits. This is not day trading. Some of the trades are intraday trades, yes, but it's basically the average is 2 days, but it's very fast moving. So we're basically cycling through the portfolio. The idea, again, as I showed on that one slide, is to cycle through about 20% of your portfolio every day, and if that's a $25,000 portfolio, that's $5,000 into the market every day, but you're probably pulling, likely the same amount plus your gains out on the same day as well. So it's very mechanical, in and out, putting the money in and out. When we discount by 40%, that is off the actual results. So we take the actual moves, the actual entries, and the actual peak move over the next 5 days. We discount that by 40% because, again, not everyone's going to catch the best exit. I mean, exits are always where the rubber meets the road. Some people are, really watching their portfolios. Some people don't. So, but we feel that taking 40%, gives a realistic indication of the power of the strategy.
Okay. And now I'm going to play the music.
Now you're playing the music? Okay, there's more questions. I'm sorry. But that's why I put the phone number here and the email.
Yeah, give us Roy's great. And if you have questions, just drop him a message at info@steadytrader.com. He'll get to it. And thanks, Roy. Good job. Some very good
thanks,
feedback. People liked it. So good job. Let's go ahead and...
Thank you.
Okay, I'm going to go.
Always enjoy it.
What a great session.